Hi guys, happy
Hello.
happy Monday. Thanks, Aaron, for joining. So,
Absolutely, no problem.
so I know you've got quite a few questions lined up for today, but to kick off, I'm um, going to go through a little bit of a chat around the funding stages. So let me know when you can see my screen.
Yeah, I can see. All
Yeah.
looks good.
Okay, perfect. And then after this, we'll go through some of the questions, which I believe are probably similar topics, but it doesn't matter if it's not on the same topic. So absolutely fine. I kind of just wanted to touch in because there are other funding stages other than angels and VC, but I just really wanted to focus on these two. And obviously, before you tend to have sort of family and friends. And in this kind of area of sort of the angels, from 10K up to 1.5 million, you can have family members say that, oh, I'll invest 10K or 2K or 5K or 50K. So this really is trying to touch that broad span of investors and what they really look for. So typically, and obviously it is a range, and dependent on the area, the niche, or the industry, or the sector that you're in, there will be different sort of standards within that. So it's really helpful to do your research around the different sectors and what the different angels or investors in those areas expect to see. So, for example, when I started my business, I had angel investment, but I didn't have a prototype at that point. I actually just had business plan. And the reason I got investment up front is I needed my time to dedicate to building it and to planning it out. So at that point, I still had a pitch deck, I still had an idea, and I had to go through essentially everything that you do cover in a business plan and a pitch deck. But it was two sort of friendly angels who already knew me, which is one of the benefits actually of networking and building out your relationships with investors before you need to ask for money. They get to know you, they get to see what you like, you'll have conversations around what your interests are, what your passion areas, your experience. And for me, I had actually worked with the investors before they were on a board of directors at a business that I then became the CEO of. So they knew me, they liked me, they trusted me, and they knew my capabilities. So when I went to them and pitched, I actually pitched a couple of different businesses, and then in the middle of that process, I in validation, I took myself out of the first business. So it's really important when, or rather, I took myself out. I said, no, that's not something I want to do, because I couldn't see that the product market fit or my niche, my understanding was a perfect fit for the business. So it's so helpful in creating a pitch deck or a business plan at whatever stage you're in. So if you're in ideation, even the process of going through all of those components is really helping you to validate whether it's something that is going to work. Is it a big enough problem? Have you got the right solution? Are you the right founder to run with it? And if you are, that's when you can start talking to angels. And ideally, in that whole process, you've already been connecting, you've been networking, and you've been building a relationship with angels so that you can show them. But typically, let's just imagine a typical scenario. They're going to want to see something. So to have something more than just an idea, it doesn't need to be a full MVP at this stage, but it could be a prototype. So for example, if you have got if you're thinking about building an app, a solution, you don't necessarily need to go and build a working app. You could create a prototype in Figma. So it actually looks like an app and somebody can interact with it like an app, but it actually is just screenshot to screenshot, just screenshot with moving options. So you can click on a button and that button takes you to a different page. So there are lots of different stages to articulate visually, verbally, your plan, and to get excitement from the investor. And as part of that, you kind of need the core things, the problem, the solution, the market size. But when an angel is looking to invest, they typically are looking for these things. So just imagine you've got the core presentation, the problem, a really clear and big problem, a really clear solution. You are really well suited to deliver that solution, and your experience or your passion is perfectly matched. And then in addition to that, when an angel is looking to give some money, they're going to want to see that to actually see that brought to life in a way that they can understand. So having a prototype is a great way. The MVP can span a few different stages. So you could have a later stage or a higher amount of investment from an angel, and have a sort of a tiny little MVP that you're then you need that investment, a bigger investment, to get the bigger MVP, and that's okay. Within all of these sort of MVPs, you should be doing user testing, speaking to your customers, trying to validate wherever possible your idea. And ultimately, that's kind of part of running and building a business, is to get validation that what you're doing is right, not just for the investors. A lot of the time, founders tend to go ahead and they build something without even validating whether there is a real need for it. And it could be that you're going ahead and you're going to deliver something that, with a slight tweak, slight change of articulation, you can then deliver something that somebody goes, yes, I actually want that. Whereas if you go ahead and just build something without validating it, without prototyping or MVPing and testing it with real customers, real potential users, you could be wasting a lot of money, your time, and ultimately angels' time. So they like to see that this has been done. So in the validation step, that really is about, doing some research, whether it is you've got an MVP or you haven't got an MVP and you've got a prototype, and that you're just funneling people through the prototype, or you're asking your target audience for feedback on a questionnaire, or you're going ahead and actually interviewing your potential target audience. It's about getting in front of them and then using as much data as you possibly can to put that in your pitch doc for an angel. Ideally, you'd have some initial customers, but I didn't have some initial customers, and lots of people don't. But what you can do is you then go and speak to somebody who would be your ideal customer. And if it's just, if you've got a marketplace, you're going to have two types. You're going to have, say, for example, customers and brands, or there'll be the buy side, the sell side. And it would be really about trying to get feedback and input from both of those sides. If you have two sides, if you have one side, then that's it's an easier job to do, but you really want to validate their interest, ask them what their problems are. And again, as you're speaking to your customers, you're finding out what are their biggest problems, and then you can build that into your business to make sure that you can present and create the right solution for that. And then you've got the founding team. So I know last week we touched on somebody asked a question about, is it worth having a co-founder? Now, I think my answer was a little bit biased, because I didn't have a co-founder, and I went heavy in, yes, you should get a co-founder. And that's only from a personal experience. If I felt like at the time that would have been beneficial. But in reality, if you have a founding team, that also has the same benefit. Where it's really challenging is if you're just a solo founder and it's just you doing all of this. And that means that you have to create all of the energy, you have to have all of the experience. The benefit in this scenario, in the investment stages, is if you've got a founding team, you are gaining experience and the credibility. So imagine if you don't have a lot of credibility in the team and you think, well, I still need to get investment. What do I do? That's when you kind of widen your network and you try and find advisors, people that will support you, that do have the experience that an angel will want to see. But it's not really just what an angel wants to see. It's what does your business need to be really successful? That's ultimately what all of the angels are going to do. They're going to look at it and say, does this person or this team have what it takes to deliver on what they're setting out to do in the market? And if you've got somebody that's got no experience in the market, an angel's going to think the likelihood and the risk is far too high for me to put my money in that business. And so if you can gain credibility, whether that's having a chairman, whether that's having an advisor, whether that's having a founding team, somebody that's been there, done that, that's a lot better. And then ultimately, kind of as you evolve to still in the sort of, so in this stage, we're in conception, ideation. We're also in pre-seed. And then we're also kind of touching on seed. Seed kind of starts moving over to this side. You can also have pre-seed over in the VCs. But really in conception, ideation, and the first stages, which is pre-seed, this is where you'd sit. And as you scale up a little bit more, as you have some traction, then you want to show the signs of good traction. You want to see, how many customers are coming on board, how many indications do you have that your business is going to make money, or in fact, do you have any revenue? If you don't have revenue, that's fine, but you just need to find ways in which you can illustrate that it's working. And ultimately, this is about product market fit. Have you got the right product in the right market, and do people want it? And then as you go to sort of venture capital, that's when it's more tried and tested. You've got a more functional product, and you're still testing, obviously, but you're not starting from the empty space that you've got. You're not starting with lots of assumptions. This is where you've got data and you've got revenue, you've got a functional product, and you can test and you can evolve, and ultimately you'd be having paying customers here. Now, one of the things that I found is I was speaking to a lot of VCs, and ultimately VCs have a sweet spot that they're all trying to get to. And the best thing for a founder would do was to try and get into the VC's sweet spot. And that ultimately is 1 million in revenue already. So high demand, great product, great signals, and already making money, not necessarily profit. And that's saying at sort of this pre-seed, seed, or rather seed area. Obviously, when you go up and you go to different levels, you'll be having far more revenue. But from a founder perspective, you want to be thinking about really trying to get the most value out of angels when you're underneath 1 million. And then when you're going over 1 million, you need to make sure that you've got everything. If you're looking for VC support and VC funding, you really want to have a business that you think is one to be celebrated. So it means you've got paying customers. Customers are delighted. You've got a core team, a team that adds a lot of credibility to you. You've got strong revenue, great potential. It's a large market. You've got a great solution for that market, and you can see in your history that you've been scaling. And therefore, if a VC were to just follow that line of your growth, they would see a lot of value. Now, with VCs, they have really high targets. So they're looking to make an investment, and then for that business to be sold and make a huge return on their investment. Whereas angels are not looking for such a big return. So you can find that your business might not ever be suitable for a VC. And so businesses that are not going to be enormous, don't have a huge market potential, that won't be sort of well-known businesses, that's unlikely, well-known businesses within their niche, that's unlikely to be VC money. That's more likely to be angels, and angels are only going to be interested in it if they can also make a return on their investment. So I think that's kind of covered that kind of broad overview. Were there any questions from the group around anything from on today's discussion?
Yeah, maybe actually just quickly going back to that thing. I'm asking for the people who are watching, definitely not because I don't know the answer, but the difference between validation and traction, because they seem like similar words, but I think they mean different things.
Hmm. Yeah. So validation is you've got a theory and you're looking for evidence that supports your theory. So evidence that's, so you've got a theory that people would be interested in buying, I don't know, I can't think. There is a new type of device that shampoos a dog without you getting wet. So you've got a theory that people would be interested in that device. So the validation would be you go and speak to people and you say, I'm going to build this device. Do you have this problem? And some people will say, you know, I quite like getting wet. I've got my process. Actually, I pay somebody else to do it or whatever it is, and then that's a no. Or someone says, yeah, actually, I would love to wash my dog. That's a real pain. I hate getting wet. That's the one thing that I really hate. I don't mind the smell. I don't mind the whatever it is, but I really don't want to be wet. So then that's validation. Traction is when you can see demand in the sense that lots of people are coming to you saying they're interested, or if it's not revenue, it could be that you've got some conversion data that can be seen as traction. So you could have a holding page where you say sign up if you're interested in this. That kind of is a little bit like validation, but ultimately the signs of traction tends to be from your MVP. So you've got a product at that point, and so it would be X amount of brands have signed up, X amount of customers have indicated that they want to buy, or X amount of customers have actually bought. Does that make sense?
Yeah, good answer. Good example as well. I hate getting wet, so that was really hitting home. Yeah, so I'll go to the questions. I'll ask the questions from the group that they put in.
Okay.
So Abby, so in regards to investor interviews, talking about the gender bias, what to expect, what to look out for.
Well, I do think that a lot of the gender bias on the whole is not going to be verbalized.
Okay, yeah.
On the whole. So what that kind of means is that you need to go in there armed with a lot of evidence, a lot of clarity of your own mind, know your numbers, know the data, and really hit it hard. The tendency is for us to, you know, especially as first time founders, is to not go in it with your game plan of I'm going to go out there and really share. And you've kind of got to get through the unconscious bias, which is and it's really unfortunate, you know, but and we can stereotype, so it's hard to kind of, you know, you want to be confident, you want to know your numbers. Where you're going to have some problems is they could be thinking, I'm going to invest in somebody that looks like me, that I recognize myself in, I see myself in, and that tends to be white males. And so as a female, you've kind of got to really stand out. So you have to be really passionate, really have a lot of experience, excite them, have a pitch deck that the numbers are great, the theory is great, the research is great, the presentation is great, the slides are great. So you kind of got to do a lot more to stand out in the crowd, because you're up against that that challenge anyway. But there are some questions, and you know, I think most women have probably come through this, unfortunately. Whereas, you know, I've had it through my years, not in the sort of investment area. I have had quite a bit of gender bias in the investment kind of area, but I've also had it in work. So, oh, you know, we might not want to give you funding or the promotion or the job because you're going to go and have a baby, or you're going to have you know, you need, you know, or it's not suitable, women don't do XYZ. So at any of those points, and that was quite some time ago, in any of those points, I think it's best not to it's just to move on from it and to point it out as what a man would answer it. imagine if they would say, they wouldn't ask those questions typically to a guy. So it would be deflecting those comments and coming back with something that's really relevant and what they really what they probably are asking about without the bias. An example would be about, say, for example, if they said, how are you going to spend your time between family and work? That question could come up, but that wouldn't go to a man. So then you would then say, I have had a career doing XYZ, working XY, I have delivered on this. I'm a founder that's dedicated. I'm really passionate. I work 17-hour days. That's no issue. My lifestyle is set up for that. Or as you can see, I've delivered XYZ. I've achieved XYZ. It would be just bringing them back to the positives, and ignoring the negative.
Yeah, good answer. What do you call it? I know Abby has some interviews later on this week. We also, Abby, in our templates have a list of investor questions, and I think there's some gender bias specific questions there and answers as well to go along with them. So the next question: what are the pros and cons of securing investment from an individual angel investor versus an angel investor group?
Ah, okay. So I would say there's not. The benefits of being with a group is that you've got access to more investors. It tends to be, in my experience, that when you meet or when you get to know an angel, they're connected to other angels, and so they tend to invest. If they're smaller ticket size, they tend to invest together, and they loop all their friends in. So if somebody's going in on an investment, they would say to their friend, "Oh," and they'd pass a recommendation on. They were doing an introduction. But then if you've got, that's like individual investors. And so I've just flagged that we're limited on time today, so we've only got another 5 minutes. But for a network, that's when the benefit there is that you've just got a wider audience. So it's not necessarily a benefit of going specifically to an angel network. It's just having more angels to work with and ultimately have a successful outcome. The negative or potential con would be having too many angels at low ticket sizes on your cap table. But ultimately, I actually see it as more as an opportunity to either get a limited amount of angels, which if you try and expand within that base, you can still get enough. Or if you're really struggling, then definitely go to an angel network, see if you can pitch in front of all of them, see if you can get your pitch deck out to everybody. And then again, that network would probably only produce a few that are interested anyway.
Time for one more question?
Yes.
Okay, I think there was one that was on topic here. Yeah. Should I focus on building traction or refining my MVP before pursuing pre-seed funding?
So again, should I focus on building traction or building my MVP?
Refining my MVP. So I'm guessing they have MVP and just want to, yeah.
Oh, did you say before VC?
Before pursuing pre-seed funding, they're saying.
Oh, okay. If they've already got an MVP, I would take it personally to the limit of their MVP and try and get as much traction within that MVP, so that when they show that to an investor, that all of the numbers look amazing. Whereas if you were to take that energy out of trying to get all of the traction that you can get and focus it on building out the product, yes, you might have a better product, but ultimately you don't have the numbers, the data, the traction, and that's what sells. It's the numbers. It is the traction. You could say, I've got a fantastic MVP. It does all this. It's amazing. But if it's got no traction, you've lost. that opportunity. So I definitely think it's about prioritizing traction first.
Try squeeze one more, or should we end?
I think I go on. If there's a quick one, I'll try and do it really quickly. But I've got to jump on another founder call.
How much equity is reasonable to give away during the pre-seed stage?
Yes, no, I think I've got a post somewhere that I've shared that's kind of broken it down. You really, in the very early stages, you want to be trying to limit your equity, because ultimately, the more as you grow, you're going to likely need more investment, and every time that you get more investment, you dilute your pot. Now, ultimately, it's better to have you kind of need it's a balance. So I would say map out. We've got a tool in the tool, which is effectively working out your equity dilution, and you put in what you're trying to achieve, and then in that round, and then you map out all the future rounds, so it tells you what you're left with at the end. As a ballpark, 20%, and if you can get lower, great. Don't go higher. Don't go above. Do not go into the 30s. If an investor's coming along and asking for 30%, take that as a massive red flag at that stage. They will do it if they can. Try elsewhere and try and get it below 20 or under.
Cool. I think that's a wrap.
Thank you very much. We'll look forward to our next session.
No problem.
Okay. All right.
Bye-bye.
See
Thanks
you.
very much,
Bye.
Lena.
Bye.
Bye-bye.